So when we look at commodities, obviously the largest commodity is actually cash. Then the next commodity after that is oil, and then iron ore for us. So let's just spend a bit of time in talking about oil and general commodities. Where do you see the market in 2016?
Look, the commodity cycle at the moment, obviously we're at, we've got the issue of China transitioning their economy.
Yep.
So we're looking at the hard commodities factor, we're looking at the iron ore, the nickel and all those types of things. Obviously that's been depressed, and it has been depressed for a couple of years now. A lot of the analysts and a lot of the valuations that we see in a lot of the stocks at the moment are probably factoring in certainly much lower long-term average pricing on iron ore and those types of things.
Yep.
On the oil side of things, that has certainly dropped quite significantly.
Yep. Bounced off its lows of $26, but yeah.
That's right. It's bounced off at the moment, probably on the back end of some rumour and conversations about the Russians
and the OPEC getting together in China.
Oil's an interesting one because at the moment, we've probably got a production supply surplus of around about 2 million barrels a day.
Yep.
The US is obviously still producing. I think the expectation that the shale gas production's coming off significantly hasn't quite eventuated to the point that they actually built up their reserves late last year, and hence we saw a bit of a drop.
Yep.
The oil price is an interesting play in that when I spoke earlier about inflation being relatively low globally, it's interesting that the core inflation is around about the 2% mark or just under, but headline inflation is sub 1 for a lot of these developed economies because of the impact of oil.
Yep. So basically for the listeners, what happens there is oil is involved in a lot of products that we use, and so if the cost of that is significantly lower in the raw materials, that can potentially flow through to the actual realised price of those items.
Yeah, and so with the oil market at the moment, so we have a little bit of the supply glut, but also the other part of the equation is the demand, which is the conversation. I think on the demand side that has been maintained, because if we look at China, for example, their GDP was only 6.9 last year, but on the flip side of that, they still managed to have an 8.8% increase in oil consumption. So if they do maintain the 6.9s and 6.5s, you should still expect some growth in demand in that space.
Yeah, and I think the US and the Northern Hemisphere coming out of their winter, which has been a pretty bad winter, so less travel. I think you'll see some more consumption on that oil side, especially if so cheap. So I suspect you'll see the big four-wheel drives getting around America and in Canada and those types of areas. So again, I think we'll see probably more consumption at that price point.
Yeah, so principally the oil discussion is around supply side factors, in that there's certainly some political games being played, economic games as well, in that people are trying to protect their market shares, or certain countries are trying to protect their market share. And that's probably one of the black swan events as well, given the price of some of the instability later in the year. So obviously heavily reliant countries such as Venezuela, Brazil and Russia, in particularly Russia, given the oil prices, it is heavily eating into their budget deficits and reserves. So the longer this persists, the closer they are to potentially defaults on their government bonds. So that's something to keep an eye out on.
It's an interesting point.
Yeah, so we just need to be mindful of the fact that if the oil price stays too long, and which is probably why we find that the Russians are having conversations with people.
So iron ore, where do you see iron ore?
With the iron ore, unfortunately that's probably going to stay reasonably low, because at current levels, unlike the oil, which is a supply side issue that can be quickly adjusted. Iron ore, on the other hand, we have both a supply issue but significantly a demand issue. In that Chinese transitioning,
slowing demand.
So with the transition into the services or consumer base, they don't need as high a level of steel. But which, following from that though, is that we're looking at probably a better outlook on other commodities, hard commodities like aluminium, which is a second stage or second tier commodity, in that once you build the roads and the cities, then you need the fridges and all the other lifestyle goods.
So, aluminium, any view on nickel and copper?
Look, they're both trading at historical lows. You could probably put nickel and copper again closer to the second tier, second stage commodities as well. But notwithstanding that, all commodities are still being heavily depressed at the moment.
So not a great year in the commodity space or the mining space, but that being said, potential opportunities.
Yeah, absolutely. There's opportunities in that. Again, sometimes we have to step away from the real world to the financial world, in that the real world is driving the prices, which is forcing a lot of pressure and profits on the stocks and the companies themselves, which, if anything, opens up the door for mergers and acquisitions. So we might start seeing a few more of these come through over the next 12 to 18 months.
Yep. Obviously, cash flow is big. Debt levels are going to be important. Companies are being marked down for their debt levels, or mining companies on the stock market being marked down for their debt exposures. The risk to dividend payments and those types of things, if they're not, positively generating cash flows in their operations, there'll be a lot of cost cutting. So we'll start to see more of that.
Yeah. So there is that. From that perspective, I think there is that opportunity for mergers and acquisitions. I think the other factor is the other black swan event, I think, relating to oil, is probably the size of the hybrid debt. So there's been some conversations and discussions about the spread in hybrid debts, high yield debts in the US, because essentially a lot of these US companies, shale gas operators, were borrowing money, issuing debt when oil was at $100 a barrel, and any profits from future sales would be used to pay down the debt.
Yes.
But now that oil is trading at 30s and 40s, they're obviously not going to be in a position to pay down some of that debt. So there is a concern with the level of debt in that space and any default in that.
Yeah, I think there's no doubt we're going to lose a few of those shale operators, and I think that's probably part of OPEX and point in terms of flooding the market to a degree, get rid of those cheaper operators out, and then hopefully have a sustainable price point that they can then ensure that they can maximise until their oil runs out in 50 or 80 years.
Yeah.
True. So that's a good wrap up in terms of the commodity stuff. Let's go over to